YouTubers, Mike Martin's here, Mike Martin's channel. It looks like credit card companies or credit cards in general are getting somewhat desperate or looking like they're riding a fine line with creditors. Now, people obviously take credits and buy now, pay later. And the problem with this is buying things on credit has become accustomed now, a normal thing. Governments are telling people, yes, borrow. It's okay. The older generation never carried debt because they just don't understand debt and how cheap it is to borrow. And yeah. So today we're going to look at debt, and today we're going to look at what's been happening with the 5 Canadian banks. And it's kind of important that we discuss this. Never, ever convince yourself that it's okay to carry a little bit of debt. It's okay to build a little bit of a credit score. It's okay to carry some debt to build some sort of credit score. That's fine. But putting groceries and stuff on debt and putting things on debt that you shouldn't be putting on because you feel that you could just pay it later, you're young and you have your whole life to pay it back. But how much of your life are you going to use to pay it back? That's the question in the end. So here it is, guys. This is the article that popped up today. 5 Canadian banks cut credit card interest rates to ease COVID impact. So again, they're going to be pumping up the COVID. Now, you guys need to understand something. This was happening a long time ago. This was happening months. We started seeing the signs of this in early 2019. We started seeing the signs of this starting to crumble. So this is not a new thing. This is something that's been happening. But then COVID came in at a convenient time to kind of, yeah, you be the judge of that. So Toronto, Bank of Nova Scotia, Toronto Dominion Bank, Royal Bank of Canada, and National Bank of Canada, Canadian Imperial Bank of Commerce said on Friday it's cutting its interest rates, credit cards to provide relief to customers affected by COVID. So there it is. And then in the other article, let me get to it right here. Let me see if I could find what I'm... no, it's the other article. Right here. Okay, so here it is. There are the banks right there. They're giving up to 6 months temporary interest rate change. They're going down to 10.99. Scotia Bank, up to 3 months. So there's the temporary change. And then there's TD right there, 3 months, 50% interest rate cut. And then you got RBC, 2 months with options to reapply, I guess, 50% interest rate cut, and then National Bank up to 3 months at 10.99. So there it is, and there's your payment deferral length and temporary interest rate change. Now, this is a big deal because what's going to happen? Okay, right here, watch this. The bank reported almost 30,000 customers have reached out for advice and relief in recent weeks, including deferrals on payments of credit cards, loans, mortgages, and debt consolidation. The TD Helps program has been in place since 2008 financial crisis. So, okay, so they have obviously things in place. The banks obviously know things aren't going good right now. Now, here's the deal. How long could people weather this? How long could people fool themselves into thinking that they're good, they're financially stable, right? And it's scary. I'm not trying to scare anybody out there. I just want to make sure people understand. And what I'm going to bring you today is I'm going to bring you a bit of answers. So look at what you have and what you're paying. Revolving versus installment credit, what's the difference? So here it is. Installment credit is extension of credit which by which is fixed schedule payments are made until the loan is paid in full. Okay? Revolving credit is credit that is renewed as debt is paid, allowing the borrower to access a line of credit when needed. Now, and to reduce or eliminate the burden of revolving credits, some consumers use installment credit to pay off revolving credit debt. Now, I recommend everyone to start paying down their cards as much as possible, especially the higher interest ones. Now, why do you want to pay your higher interest cards off first? It's because you're paying a blended rate. Now, if you take all the interest rates you're paying with all your different cards, you'll notice cards like Canadian Tire, Sears card, or whatever, Macy's cards, whatever, they're going to have the higher interest rates, right? So with your blended rate you're paying, those cards or those store cards, those store shopping cards or whatever, you're paying 30 points or 29.95% interest. That's 2.95%, 2.99% a month in VIG. and interest. So you got to be really careful whether you're. So what a lot of people have been doing, and a lot of people have emailed me, I told them to take their revolving debt and ask them, your bank, to cancel it and put it on an installment plan for 48 or 36 months. Never put 60 months. Never. But 48 or 36 months. Now, let's take a look at simple interest versus compound interest, okay? So this is kind of important. Interest is the cost of borrowing money where the borrowers pay a fee to the lender for the loan. It's kind of simple, right? Generally, simple interest is received over a certain period, is fixed by a percentage of a principal amount that was borrowed or lent. Compound interest occurs and is added to the accumulated interest of the previous periods. So you've got to watch out for the compound interest. So borrowers must pay interest on interest as well as principal. So even if they do lower your interest to a good percentage, watch out, because depending on what interest you're paying on your card, you'll end up paying it off 3 times whatever you borrowed if you make the minimum payments. Be careful. Open up a TDS calculator, start looking at your interest rates, be honest on your total debt service ratio calculator, find out how much money. I have friends that I speak to, and I tell them, look, let's do a TDS calculator, let's do a total debt service ratio calculator, and let's take a look. Let's take a look at how much you have left over for food. Never mind to buy a car, never mind to buy another expense. Let's take a look-see how much you have left over for food. And a lot of people are shocked when they only have $28 or $70 a month to scrounge for food. I've seen it before, many times. A lot of people need credit counseling, not more credit. A lot of people need a better restructuring of credit. It's very important that you guys understand the difference between compound, simple interest, understanding revolving credit, and understanding what you get yourself into when you are basically signing up for these cards. Be very careful, guys. I really want to put this out there because I just, people need to stop being comfortable with taking debt on and start looking at ways of bettering your financial, maybe take a second job to pay off a few cards down or pay them off entirely. You'll start to see more money. You think you're rich because you got it to borrow, but realistically, you're borrowing it with a high VIG, high interest. VIG is dangerous. They call it underjuice. It's also called undercurrent. And yes, gold is skyrocketing. It's over $2,060, $70 an ounce. Silver is going to break the $30 mark. And not only that, but what's really weird about that, and I talked to you guys about this, I shorted like 3 gold stocks. All 3 of them went down. I shorted 3 gold stocks, and I can even tell you, and Matt, you see, that's something for another. We got to talk about junior miners, understanding junior miners, how they reflect the price of gold. Because the 3 gold stocks that I bought, I shorted them, a short. All 3 of them went down. So that was really weird, how the price of gold skyrocketing. Remind me to make a video on that. I'm gonna get a miner, an expert, a minerals expert on the show who actually mines gold, like for a big company. And that's what he does. So we'll talk about that another time. But still, I kind of wanted to throw that out there for you guys because I want to make sure people understand the dangers of getting into debt. And getting into debt could be a lifelong burden. So be strong, know the game, understand what they're offering you before you sign on the dotted line. Let me know what you guys think in the comments below. And are the banks getting desperate? What are the banks realizing? I think the banks are starting to realize they're charging too much VIG. Comment below. Look forward to reading your comments.